Where the jobs go, people follow. It's a real simple mathematical formula. Real estate's not complicated. Where are the jobs? Where are the people? And where do you have a supply-demand imbalance? Those are the locations you want to be buying in. Welcome back to another episode of Keeping It Real Estate. I'm your co-host, Dan Brisse, and if you're considering investing in Dallas-Fort Worth, I think you guys are at the right place. We're going to examine the most current economic data, the supply and the demand dynamics, and how we're underwriting multifamily deals in this market right now. And we pulled the most relevant data from Costar and just recent census reports to give you all a real-time snapshot of the Dallas-Fort Worth market right now. So as we're searching for deals, we're looking to identify the best deals from our perspective with, based on the trends and patterns we've seen over the last decade in very high growth areas of the Dallas-Fort Worth metro area, as well as Nashville, as you guys know. And our investors, they choose us to provide cash flow, tax savings, and really our job is to ultimately build wealth long term. So if you want to see the investment opportunities that we provide to our investors, you can go to granitetowersequitygroup.com/invest and fill out the form to join our mailing list. And there's no commitments here by you guys filling out the form. The only thing is you're going to see future opportunities to invest with us. Okay, let's dive into today's episode. We're first going to start talking about landlord-friendly laws, and this is so important, you guys. So when we identify a great market to invest in, we have 4 top criteria pieces that we're really looking for as our base. And the first is job growth and diversity, and the second is population growth. So these 2 factors, they ultimately drive demand for apartments, and supply and demand controls everything. We've seen this in some markets where, we've had one major employer or one major part of the economy, such as oil. And when oil crashes, we've seen supply and demand get completely out of whack. Yeah, it's great when it's booming and you're at 96 to 100% occupancy pushing rents, but it's awful when, during COVID, oil dropped, the world stopped traveling and all the drilling stopped and all of these oil refineries and all these companies went away and all of our residents went away. The third is business-friendly laws. So for example, Texas has no state income tax, which makes it a great place for corporations and their employees to live. And then the fourth is landlord-friendly laws. We want to have fast eviction timelines and no rent control policies. And so if you invest in someplace like San Francisco, for example, there are strict rent control laws and tenant protections that can make it really difficult to run a business and expensive and extremely time consuming for landlords just to evict. So even if they stop paying, it's hard to get them out, if you can believe that. Eviction cases can take several months or even years to resolve, during which time these residents, they're not making any payments to the property. And you as the landlord are responsible for all the bills and the mortgage. The lender's not going to let you off and say, oh, it's okay, the residents haven't been paying. You don't need to pay your mortgage. Your mortgage is due no matter what. So this is one of the reasons why we prefer to invest in markets with more landlord-friendly laws and a faster eviction process. Now, of course, we assist our residents by connecting them with state housing associations to provide rental assistance. However, it's not always possible for us to help them, and sometimes they don't want to be helped. So that's when an eviction is required, and it's real simple. When they sign a lease, we expect them to live up to that lease. If they don't do that, they need to go. And so that whole landlord-friendly piece is the ability to control the business, the ability to evict residents in a decent amount of time, ideally 30 days or less, so you can get your unit back and release it to someone who is a good paying resident. So those are the 4 pieces of criteria we use to identify a great market to invest in: a growing, diversified job market, population growth, business-friendly laws, and landlord-friendly laws. So let's see if the factors are in play in Texas, and then we'll zoom in further on Dallas. So Texas is an overview for you. Those of you guys that don't know, it's home to a $2.4 trillion economy, which is the second largest in the U.S., and it trails only California. The state it's home to over 100 of the 1,000 largest private and public companies in the U.S. Additionally, Texas has no rent control policies and no state income tax, which makes it a very attractive market for investors and residents and businesses. So Texas laws check the box of those two pieces of criteria: very business-friendly laws and landlord-friendly laws. So let's take a quick look at Dallas and the Fort Worth metroplex. Dallas-Fort Worth's economy is thriving, and it's driven by a diverse industry based on significant population growth. And for us, population growth, you guys, is led by job growth. Where the jobs go, people follow. It's a real simple mathematical formula. Real estate's not complicated. Where are the jobs? Where are the people? And where do you have a supply-demand imbalance? Those are the locations you want to be buying in. And Dallas-Fort Worth leads the country in job growth, adding over 410,000 jobs since just February of 2020. And the current unemployment rate in Dallas is 3.8%. A lot of the tech giants that we're seeing, the Facebook, Google, Apple, they have a substantial presence in the region that further enhances the economy expansion. You've got major corporations like Toyota, State Farm. They've all established headquarters here, and they're contributing to job growth and economic stability. And then you've got the healthcare sector, which is a significant employer with institutions like Baylor Scott and White Health and Texas Health Resources, which supports tens of thousands of local jobs. And then you've got the Dallas-Fort Worth International Airport, which is one of the busiest airports in the world. And I can speak to that because every time I'm there, it's packed and it's massive, which this just further stimulates the economy. And it's located centrally between Dallas and Fort Worth. And then taking a look at our second key factor, which is population growth. So the Dallas-Fort Worth metroplex is expected to grow by 9% by 2028. That's a huge number, making it an ideal market for multifamily investments. And from 2022 to 2023, the metro led the U.S. in population growth, adding over 153,000 new residents. Over the past decade, the average annual population growth in Dallas-Fort Worth metro has been 133,000 residents, which is a very impressive stat. It's over 100,000 people continuing to move to Dallas year over year. So imagine that, 100,000 more people coming into Dallas every single year. And that led to vacancies rising to 11%, which is above the 10-year average of 8%. However, the 11% vacancy figure includes properties currently in lease up. So stabilized vacancy is currently at 8.4%, which is a much lower figure. So when I'm saying that the 11% takes in current lease ups, you've got some properties that are brand new that are starting at 0% occupancy, 10%, 20, 30 as they lease the property up. That's what's taken into consideration of the 11%, those brand new builds. But if you look at the stabilized vacancy rate, which are properties that have been built for years, you're currently at 8.4%, which again, a much healthier number. Multifamily construction in Dallas-Fort Worth is definitely slowing as the cost to finance these new projects has become much more expensive. The rapid increase in interest rates that we've all seen over these past 2 years has played a part, of course, in that. However, developers, they are also facing more challenges, such as you've got supply chain bottlenecks, you've got inflationary pressures, and you've got the availability of construction materials and just the overall cost of employment and hiring people. Permitting activity has decreased from a peak of over 30,000 units last year to around 24,000 units. And according to the latest Census Bureau data, currently there are 49,000 units under construction, which represents about 5.6% of the inventory. Deliveries are expected in 2024 to peak and then drop off significantly from there as the construction pipelines fade out from these higher interest rates. And unlike many peer markets that are facing significant supply side pressure in the near term, Dallas-Fort Worth is relatively well insulated. With construction levels tapering off and demand stabilizing, vacancies and rent growth in Dallas-Fort Worth are expected to recover faster than in peer markets in the Southeast. Another theme that is giving tailwinds to Dallas' rental market, along with the U.S. as a whole, is the affordability gap of renting and owning a home. It's at an all-time high, which makes renting either a more attractive or a requirement. And what that means is as you want to go buy a home, homes are more expensive significantly than they were after the pandemic. Plus you've got interest rates that have gone up so much, your payments are unattainable and people are forced to rent. Dallas-Fort Worth in particular has a very tight single family market, which has created a higher barrier for households seeking home ownership, which again keeps more households in the renter pool. So our strategic approach here at Granite Towers, you take all that data and it's like, what does that mean? So we're focused on acquiring B and C class assets in Dallas. And if you don't know what a B or C class asset is, it just means the properties have been built between the late 60s and early 2000s or late 90s. And we found that there is a massive opportunity to add value to these assets in specific locations with the specific demographics. And they tend to fare better during these economic downturns, which is pretty obvious because if you're owning a brand new A-class sexy property, which is a lot of people want to own because they want to be able to say, yeah, that's the asset we own. Look at that beautiful piece of property. A lot of times, not always, but a lot of times these new builds when they're coming on like they are now affect those types of assets more because these new assets come on and they have to lease up and more products available. You have a supply demand imbalance. So our primary strategy to add values is to renovate units and to simply adjust rents to what the market levels are now. That's not pushing and creating a new level. It's saying, what are the deals doing today in the submarket? What are our competitors doing? And how do we build a plan just to simply match what they're doing for rents? Can we build that CapEx budget into our plan? And figuring that out involves studying the submarket and neighborhoods to identify what the achievable rent prices are after we implement our upgrades. So for example, if there's a property right across the street that has an updated appliance and counters and they are achieving, let's just say $150 higher than our property that we're analyzing, there's an opportunity likely to add value by completing similar renovations and pushing rents to similar levels. And so that's the way we look at getting our primary data. We call that primary data. What's ever going on the ground real time today? What are the competitors getting? How are their amenity package? How are their upgrades? And how is their location comparable to ours? And can we recreate that or can we beat that with a CapEx budget as we take over? Going into a little bit more detail, let's just say you spend $8,000 to upgrade a unit and achieve a $150 rent premium. That's an additional $1,800 per year. And you divide that by, let's just call it a 6% cap rate because right now cap rates are right around there. You created about a $30,000 value increase by upgrading the unit. So you spent $8,000 to create $30,000 of value. That's what we're looking for. And that's not even that big of a home run deal. That's just decent. Ideally we could spend less and create more of a rent bump. So as we are searching for deals, we're looking to identify the best deals, and best deals will be different from group to group. And when we say best deals, there are some patterns and trends that we've found over the last decade of doing this and owning 18, 19 deals, 20 deals. And we have found some patterns and trends that have proved true for us. So when we're saying best deals for us based on what we've seen. It doesn't mean it's the best deal in the world, but we're looking for best deals for us in high growth areas of Dallas. And if we're buying a property, we want all of the nearby comparable properties to be occupied at 95% plus. And that just proves out that there's extreme pent-up demand in the submarket. And when we look at deals, every time we bought in a submarket where we found 95 to 100% occupancy in a B or C class location that can't really be rebuilt, you have an opportunity to improve that asset, and it increases your chances significantly to be able to move your rents to the market's rents. And so as long as you've got the right CapEx plan and you've got debt that's in place that can weather a storm, an economic downturn like we're going through, you put a lot of wind at your sails to hit or beat your projections. Over the past 12 months, our team at Granite Towers, we've analyzed 225 deals, and only 11 of those have fit our criteria where we've really gone deep. And so let's just say we have 500 deals that come across our desk over a year. We might not even open up 250 of them. We might just look at the location, the size, the unit count, your built, and just say that's not our sweet spot. But of the 225 we took a look at, we really only went deep on 11, which that's a relatively small percentage of how much we're looking at. So if you want to see investment opportunities that we are providing to our investors, you can go to granitetowersequitygroup.com/invest and fill out the form to join our email list. And that link is also available in the description of this podcast. And again, there's no commitments here made by filling out the form. It's only the opportunity to see future deals and investments. We will need to connect with you at some point to build a relationship, as our offerings are 506Bs. So that is part of something that we're going to have to get to know you. If you want to invest, we're going to have to understand your investing goals. Be nice for you to get to know us better. Keep listening to our podcast so you can get to know Mike and I better. And hopefully there's an opportunity for something in the future for us to buy as a team. So that's it for today's episode. Thank you for tuning into this episode of Keeping It Real Estate. Again, if you want to see our upcoming investment opportunities this year, you can click on the link in the description of the podcast and fill out the form to join our email list. And thanks again for tuning in, and keep on listening to the show so you can become the best real estate investor possible. Have a great day.